Hello and welcome to this session. This is Farhat, in which we will discuss auditing accounts receivable. Let's start by creating a receivable, putting a receivable on the books. How does that happen? Well, it's a result of a sales on credit. What does that mean? It means account receivable is created when we make a sale. Therefore, we debit account receivable, we credit sales revenue. Well, what does that mean? It means account receivable comes as a result of sales. Now, account receivable is audited as part of the whole sales collection cycle, because account receivable brings sales, or sales brings actually sales. As a result of sales, you have account receivable, then eventually the customer will pay. So revenue recognition, because revenue is involved, is a significant risk in most audit, because auditing standards require auditors to assume it poses a specific fraud risk. So once revenue is involved, you always have to assume fraud could be involved. Therefore, when we sell something on credit, on account, the double entry nature of accounting reinforces this presumption, because account receivable goes up, sales goes up. That's why you increase account receivable. It's when you sell something on credit. Now, what's the next thing that happens? The next thing that happens, if everything goes well, we receive the cash. Once the customer pays the cash, we increase the cash and we reduce the account receivable. And basically, in a perfect world, this is basically what it comes down to. Account receivable increased by 10,000, account receivable decreased by 10,000, revenue increased by 10,000, and we received cash of 10,000. This is what usually happens. Well, that will be great if we lived in a perfect world. However, we don't. We have to determine also the valuation of the receivable. We have to determine the proper reporting of the receivable balance. Why? Because when we have receivables, okay, we have 10,000 worth of receivable, we created a receivable of 10,000, or we have a total of 10,000, that does not mean we are going to receive $10,000 in cash. Why? Because we are going to have to account for something called allowance for uncollectible accounts. And we will have a whole session about how to audit allowance for uncollectible accounts. But allowance for uncollectible accounts is when you have to guess how much of your receivable you will not collect. And that's going to determine your proper net receivable. It's going to determine the valuation of the receivable. Now, when you determine this valuation, when you determine your allowance, you can do what? You can overestimate, underestimate, intentionally, unintentionally, or create a fraudulent misstatement. Therefore, auditors may identify the risk of misstatement related to valuation assertion for account receivable as a significant risk as well. So it's not only you created sales and sales created the account receivable, and because of that there is the presumption of fraud risk. After the fact, after you record the account receivable, you have to determine the allowance account, and for that allowance account we have other risks to worry about, because you can overestimate or underestimate the net receivable, the account receivable, the amount of the receivable that you would receive after accounting for the bad debt. So in this session, what we'll do, we would look at the substantive testing for account receivable. What are the different things that we have to worry about when we are auditing, when we are testing account receivable? Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
So when it comes to testing of receivable, well, we can do what? Substantive test of transaction. And we do so when we analyze and when we look at the internal control of receivable, we can test certain transaction to make sure the system is working properly. For example, when you sell on credit, for example, one of the internal control is making sure we approve the customer's credit worthiness before we grant the credit. This is part of the internal control. Therefore, when we are looking at certain transaction, we could do some testing. And we looked at, internal control for account receivable and sales in prior sessions. You can also do analytical procedures. You could also use analytical procedures as you are testing account receivable. So you can use that. Although analytical procedures, remember, as part of substantive testing is an optional step. Now remember, you can have analytical procedures at the beginning, at the end, and in between. In between is when you are testing the balance. That's an optional step. And we will cover later what type of analytical procedures you can run for account receivable / sales, because they go hand in hand because of the double entry accounting. And remember, analytical procedure is an efficient, cost-effective way. You may not want to rely on it all the time, but it's a method. The third way to do so is to test of detailed balances, and this is what we'll focus on in this session. We're looking at the balances, account receivable balances, and we are testing for details. So we must gather appropriate evidence from various balances, specifically the receivable, to satisfy the account receivable related objectives. Now, what are the account receivable related objectives as far as we are concerned? What are the assertions? Existence, completeness, valuation, allocation and accuracy, classification, rights, presentation. Now, in certain textbook, for example, they would say existence / occurrence. Now, why would they say that? They would say that because occurrence is a transaction related, which is related to sales. So when you have an occurrence, when a sales takes place, then we have an account receivable. But if we're dealing strictly with account receivable, we only mention existence. Just FYI, so if you saw existence / occurrence, so it's basically kind of this, not kind of the same. One is for transaction, one is for balances, but because of the dual nature of accounting, you could say existence / occurrence. But we're going to go over each one of them separately. Now, bear in mind, some of the terminology might be a little bit different if you're using a different CPA review course, if you're using a different textbook. Because in auditing textbook, what they try to do, they try to cover the AICPA standard, the PCAOB standard, and the International Accounting Standard. So they might use a slightly different terminology, but the topics are the same. Let's start with existence. What is the objective when we do existence? What's the objective of this step? It's to confirm that the account receivable actually exists. The balance, real. The balances that we see is real. Now, what do we have to do to confirm existence? Well, we can do many things, but the best way to do it is to gather certain type of evidence. What evidence are we looking for? Confirmation procedures. Sending confirmation to the customers, to the people that owes the company money, is the best way to confirm. Now, we could have positive confirmation, negative confirmation, and we're going to have a whole session about confirmation, because confirmation is so important as part of account receivable audit. We can also review subsequent cash receipts. What is subsequent cash receipts? So when we are auditing a company, this is period 1, and in period 1 they have an account receivable worth of $800,000. Great. Period 1 ended. Now what we can do is we can wait until period 2, and the first 30 or 45 days we can wait to see the cash that the customer sent against those payments. And if the customers are sending the cash, it definitely the account receivable does exist. We could also inspect sales document and shipping documents. Of course, we can do that as part of the audit, but the best way is to get external evidence, and even better than the external evidence is receive the payment. And this way we can confirm that those receivable actually existed as of period 1. Now also what we have to mention is, as I told you, the occurrence, because in some textbook they put existence and occurrence together. Occurrence similar to existence, but when we are focusing on transactions, and here specifically what transaction is related to account receivable, you guessed it. This is what I started with. I told you account receivable is created as a result of sales. So if the transaction did really occur, then we have a valid, it kind of help us with the existence. The completeness assertion, did we account for all the receivables? Now, as far as the receivables are concerned, completeness is not really a major issue, because companies usually, they show all the account receivable is to ensure all the receivable are recorded. That's always the case. Now, what do we do to make sure we have the completeness? We're going to obtain an aged trial balance and trace the total balance to the general ledger. What's an aged trial balance? Basically having the receivable broken down by age, 30, 60, 90 days, add them up, make sure they all go with the general ledger, account for everything. Account receivable confirmation, again, are the most effective for verifying existence. Remember, we are not dealing with existence, we are dealing with completeness. So we don't care. I mean, existence, kind of not the opposite of completeness, but account receivable confirmation tells you if the account exists. I'm not looking whether it exists or not. I'm looking if you accounted for everything, because the assertions here is completeness, not existence. So confirmation don't help. They are less effective for the completeness and valuation. Valuation means, do we have the proper amount? They do not provide evidence for omitted receivable or assess the collectability of recorded amounts. For completeness, what we have to do, basically, we have to look at certain transactions that happen at the end of the year and make sure that those transactions are recorded if they did actually happen. If we ship the document, if we shipped the product and we have the documents that we shipped the product, we have to make sure that the company debited AR and credited sales. Usually, again, that's not really a concern for receivable. Think about it. When you owe someone money, okay, or let's assume you have an account receivable, okay? You are going to take good care of your account receivable because you want to collect your cash. So completeness is not an issue, because as a company, you want to make sure you have all your account receivable. Now, when it comes to accounts payable, you're going to see that completeness is important, because if you owe someone money, you don't care as much as if they owe you money. If they owe you money, if you have a receivable, you want to make sure it's recorded, you're following up with them, so on and so forth. If you have an accounts payable, you're going to be lax, you're going to be more relaxed, you're going to let them come after you because they have the accounts payable. And we're going to see completeness will be more important for the AP. Let's take a look at this multiple choice questions from Farhat lectures to reinforce the concept of auditing account receivable. Which of the following balance-related audit objective and transaction-related audit objective are directly related? So we have here a balance sheet audit-related objective, a balance, and a transaction that are directly related. Okay, let's take a look at each one separately. A, classification and posting and summarization. Now, what's classification? Classification determining whether the balance is current or non-current. Is it properly classified? Now, classification could be also a balance, or it could be a transaction, like you want to make sure you classify the proper sales, whether it's operating or non-operating. How about posting and summarization? Posting and summarization, making sure that the account is properly posted, updated. The general ledger are properly updated. Now, are these two related? And the answer is no, they're separate. Posting and summarization, making sure you have a detailed tie-in of all the accounts that you process